Hey friends, welcome back to another episode of Making Sense of Your Market. Today is Friday, May 7th, 2021. It's Mother's Day weekend. Happy Mother's Day to all you mothers out there, especially my mom and my wife. My mom, Kathy Keller, happy Mother's Day. Jenny Keller, Jenny Cookies, happy Mother's Day. Jenny and I were just talking the other day about how my mom just made it look so easy, made parenting and mothering so easy. Jenny and I are parents to a 15-year-old daughter and a 12-year-old son. And boy, it is mentally, it's physically, it's emotionally exhausting. And Mom, you just seem to make it look so easy. So I love you. Thank you for everything you did and you're currently doing to be a great mom. Enjoy this weekend. And all you other mothers out there, enjoy this weekend. Happy Mother's Day. Great show for you today. Really valuable show for you today. So I'm just going to jump right into it. Mortgage interest rates are improved week over week. Now, rates didn't drop, but the cost or closing costs for those interest rates did improve. They were lowered. Now, if you don't understand what I'm saying, go back and watch last week's episode. Last week's episode, I talked about how mortgage bonds, mortgage rates move much like the valuation of a stock does day to day, week to week. And so week over week, mortgage bond prices are holding strong and they're slightly improved from last week. 30-year fixed rates are still in the 2.875 to 3.1% range, just incredibly low. 15-year fixed rates, 2.1 to 2.3. 30-year fixed rates for our veterans and active duty servicemen and women right in the mid twos. So still a great time to finance real estate or refinance real estate. If you have any questions, if you're a homeowner specifically and you missed the opportunity to save some money by refinancing your mortgage last year, I'd love the opportunity to run a savings options report for you to go over some potential savings options that might be out there for you. So reach out to me, private message me, email me, or text me. My info's on the screen. And I'd love to get you some information over the next week on saving some money while these low rates are here. They're not going to be here for long. Janet Yellen came out this last week and talked about inflation and that we need high interest rates fast. And so they're going to be rising, in my opinion, very soon. So the number one question that I get asked as a mortgage professional over the last year with these low interest rates is, Dan, should I use a 15-year fixed rate or should I use a 30-year fixed rate? And how I answer that is maybe a little bit different than the financial planners and the Dave Ramseys and Susie Ormans of the world would answer that with a bunch of data and a bunch of this and that. It's very simple how I answer this question. If you are disciplined, if you're a disciplined person and you're disciplined enough to take a 30-year fixed rate and take all of your savings every single month or the savings between a 30-year and a 15-year fixed rate and reinvest it into the stock market, do that. If you're disciplined enough to do that, do that. Now, it's not a bad thing if you're not disciplined enough or you don't want to take the risk of reinvesting money. That's fine. If you're not, go with a 15-year fixed rate. It's a forced investment account, meaning in 15 years, yes, you're going to pay a higher mortgage payment every single month, but in 15 years, you own your home free and clear. Now, if you're disciplined enough to go with option one on a $750,000 home, $600,000 loan amount, you'll have a higher cash net worth or total net worth after 15 years of greater than $250,000 if you're disciplined enough to reinvest. So if you'd like more information on that option, let me know. That's personally what I choose to do, and a lot of other people do that, and it's not as risky as you think. So let's wrap up today with Check Your Paradigms. This is week 3 of our 52-week series from Dr. Stephen R. Covey's book, The 7 Habits of Highly Effective People. We're going to go 52 weeks of these cue cards. This week is Check Your Paradigms. Your paradigms are the way that we see, that we understand, and that we interpret the world. It's our mental map. Now, that's his version or his definition of paradigms. The way that I like to define it is like lenses, glasses that we wear. If we're able to put on a lens where we can only see the good, we can only see the positive, no matter what the situation, that's checking your paradigms. And so I like to use this analogy that I learned from Zig Ziglar a long time ago. When something bad happens to you, do you react or do you respond? See, when you go, like right now with the vaccine, you get your shot and the doctor says, you've had an adverse reaction to the vaccine. Your body's reacting to the vaccine. It's out of control. But the doctor will sometimes say, hey, your body is responding nicely to the vaccine. So do you react or do you respond? This week, I want to encourage you to check your paradigms. I'm going to put some additional information in the comments below this video or in the comments in the social media thread on how to check your paradigms. But this one concept helped me 15, 16 years ago navigate over the last 15 years through some tough times, how to handle adversity. By checking your paradigms, you're able to handle tougher times or tougher situations a little bit better or recover from those a little quicker. I hope this information was helpful. If you have any questions, reach out to me. Happy Mother's Day, and we'll see you next week.